most people, when they think of a note and a mortgage, they think about being the borrower and not as being the lender. But with note investing, it allows an investor to buy and own a note. And when you do that, you step across the aisle and become the bank. And what happens is you transition from being the one making the monthly payments to being the one receiving those monthly payments.
Welcome to the Rental Property Owner and Real Estate Investor Podcast, brought to you by the Rental Property Owner Association, providing benefits and services to real estate investors and rental property owners for over 48 years. With your host, Brian Hamrick from Hamrick Investment Group.
This episode is sponsored by Green Property Management, managing everything from single-family homes to apartment complexes in the West Michigan area. Find out more at greenpropertymgt.com. And RCB and Associates, helping real estate investors and small business owners navigate the complex world of health insurance and Medicare benefits at rcbassociatesllc.com. Hello and welcome to episode 393. With higher interest rates and the distress that we're currently seeing in the banking and lending arena, investing in real estate has become a lot more difficult lately. There is a way to bypass banks altogether and actually become the lender. You can do this by investing in mortgage notes. Fred Moskowitz is an experienced speaker, author, and educator on note investing, and he's here with us today to help us understand this alternative investing strategy. Fred, welcome to the show.
Thank you. It's great to be here.
Tell us about mortgage note investing. Like, for those of our listeners who have no idea what a note is, can you just give us the 101 on the strategy?
Whenever I speak with real estate investors, I find that so many people are excited about real estate and they get involved, right? Whether it's investing in single family houses or in commercial property or multifamily. Short-term rentals is a big thing right now. That's a really popular topic. And what people often don't talk about is investing in the paper. Investing in the paper, which it means investing in the notes and the mortgages associated with those properties. And I find that it's an interesting part of the real estate business. And a lot of real estate investors don't pay any attention to it at all. Most people, when they think of a note and a mortgage, they think about being the borrower and not as being the lender. But with note investing, it allows an investor to buy and own a note. And when you do that, you step across the aisle and become the bank. And what happens is you transition from being the one making the monthly payments to being the one receiving those monthly payments. And so as an investor, you get to own the asset. You receive the cash flow and income from that. Your investment is secured by something with tangible value, of course, the real estate. And you don't have any of the ownership responsibilities of maintenance and liability for the property. And these are things that banks figured out long ago, that they would rather be a lien holder on a property than being the owner of the property, being on title as the owner. They would rather be on title as the lien holder. And there's so many advantages to that, and we can get into more detail as our conversation goes on.
When a bank makes a loan, that's a mortgage, or it can be a mortgage. What is the difference between what you're talking about, mortgage notes, and what a bank would actually do?
There is no difference. No difference at all. Now, some nuance though. What a bank, that scenario you described, that's the act of originating a note, creating a note, funding a transaction. Either the property is being purchased or it's being refinanced. And so the bank is putting an outlay of capital towards that transaction. And in return, they're receiving a promissory note and a mortgage as security for the property. And that's their collateral. And so that's originating a note. Now, as investors, we can also originate notes, right? That's what a lot of hard money lenders do. It's very popular. But also, there is an entire secondary market where notes are bought and sold every day. And most people have encountered this where they took out a mortgage, they took out financing, either they bought a property or they refinanced. And wouldn't you know it, within 3 or 4 months, you get that letter in the mail from the bank saying, "Dear Mr. and Mrs. Homeowner, please be advised your loan has been sold. Here's the contact information for the new lender. And starting next month, make your payments to them. And by the way, don't worry, none of the terms of your financing will change. Interest rates the same, payment amounts the same, everything's the same. However, please be sure to send your payments to the new lender starting next month." So that's a scenario that plays out all the time. Most of us have encountered that. And that is the secondary market. And so as investors, we can go in the secondary market and buy an existing note and mortgage as well. So those are really some different ways that investors can get involved. And a third way is, instead of owning and buying individual notes, investors can invest in a note fund that's professionally managed. And when you do that, think of it a lot like a real estate syndication, where the fund manager goes out, they raise capital, and then they'll go out to the secondary market and buy all these notes in bulk. And so when they do that, they can negotiate better pricing, better discount. Maybe they have better access to notes because of the relationships they have. And the investors who want to be passive, they benefit from all of these aspects of it. And so those are really the three ways to get involved in note investing. I'll summarize that. It is originating a loan, right? Creating a loan, either selling property with owner financing or doing private lending. The second way is to buy an existing note and build a portfolio that way. And then the third way is to invest in a note fund. This is the most passive approach because the fund managers and their team are doing most of the heavy lifting on that.
Let's go through examples of the three ways that you just outlined, starting with originating a note. Give us a real world example in which someone would actually originate a note and what that would look like.
This is very common especially in real estate investing space, where investors use hard money loans to purchase a property at below market, and they need money to fund the purchase of the property, maybe to fund the renovation costs as well. And so hard money lenders will lend on this at a high interest rate, and usually it's a short-term loan. It might be for 12 to 18 months is typical. And they will fund the purchase, and maybe they will fund the renovation and do it through draws, like the way a construction loan works. They will fund when renovations are 30% complete, then they will inspect the property and then release 30% of the renovation allocation. And so lenders, anyone can do this. All it takes is getting up the proper structure and your loan documents. And if you're involved in any real estate groups or real estate communities, you'll see that there's a lot of this. And it's great because for investors, they can move very quickly. If they find a great deal, property under value, they can acquire it quickly using hard money loans, where it's a lot faster than traditional lending cycle. So that's a little bit about originating a loan. And the other one is selling through owner financing, which where we know that a seller of a property sells a property and they will create a note and mortgage for the buyer of the property. And what's great about that is the seller of the property, they get to continue receiving cash flow from the property, yet they're no longer responsible for maintaining the property, any of the maintenance or management or any of those things. And so that is a nice benefit. So for some people that want cash flow and don't want the headaches of owning the property, it's a great way to go.
Can you just explain the difference between the different types of notes? You have your qualifying mortgages, contract for deeds, land contracts. Just in a nutshell, what are the different types and what do you gravitate toward?
Notes can be secured or unsecured, which means that they're backed by the collateral. They're recorded on title. If it's secured, it's recorded on title as a lien on the property. Contract for deed is completely different animal that I don't get involved in those, but basically it's a form of financing where the seller of the property retains title ownership until the whole amount is paid off in full. And it's something that's really state specific. There's a lot of details, a lot of pitfalls with that. I personally am not a big fan of them. Other types of notes, though, I mentioned secured, unsecured. They can be hard money loans as well. And also the position of the note. It can be in first position, second position, like secondary financing. If you remember, what you may have seen in the past were called 80-20 loans, where one bank would come in and fund the 80% of the purchase price, and then another separate lender would come in immediately behind them and finance maybe 10% more or higher, so that the buyer has to put less money down as a down payment. And so, as you can imagine, being in secondary position, it's a higher risk. And so with higher risk, it's going to have a higher interest rate and those types of things. So you have some different aspects of it. And there's other types of notes too. There's business notes, which are secured by a business or by their assets or by their receivables. You could have notes on non-real estate assets, such as a boat, a yacht, aviation. There's aviation debt. I mean, there's no limit to different things. But what I like and what I focus on are notes that are on residential properties. And one of the main reasons is they're the most plentiful. They're the most common, the most plentiful, and so they are easier to locate and to buy.
How does one go about finding an existing note that they can purchase?
Finding notes, it requires a lot of relationships. Everything in our industry is done through building relationships. Notes can be bought from other investors, from hedge funds, from different note funds. They will often buy and sell notes. Banks also sell notes. Now, some of the big giant mega banks, they sell notes too, but as you can imagine, their transactions are huge, in the tens of millions of dollars and thousands of notes being sold in one transaction to one buyer as well. And so those are some of the different ways. But what I always tell people, this is a business that's built on relationships. And so getting out, meeting people, meeting different investors, we all know each other in the industry, and we often will buy and sell loans to each other as well. And so that's how we do that and transact in the secondary market.
I'd like to take a moment to tell you about Green Property Management. Not only do they manage everything from single-family homes to apartment complexes in the West Michigan area, they also manage my entire portfolio. So I can tell you from personal experience that their unique flat fee management style is worth a closer look. If you feel that your property isn't operating to its fullest potential, then Green Property Management can help you take a holistic approach that will save you money, eliminate your headaches, and increase your net income. And if you're a property manager interested in applying Green Property Management's model, give them a call at 1-866-95-GREEN or visit them on the web at greenpropertymgt.com. If you're thinking of leaving your W-2 job and becoming a full-time real estate investor, one of the greatest costs you must consider is healthcare for you and your family. When I made this transition myself, I found the whole healthcare insurance process to be confusing and frustrating. That's why I'm glad I met Chad Creasy at RCB & Associates. Chad is a professional health insurance agent who helps real estate investors and small business owners understand and choose their best healthcare options. And best of all, his services are covered by the insurance company and won't cost you a dime. If you live in Michigan and are expecting a change in your healthcare insurance coverage for any reason, or losing employer coverage or transitioning into Medicare, then you owe it to yourself to contact Chad Creasy at rcbassociatesllc.com.
For those who don't have those relationships but are interested in investing in notes, what is the best option for them to actually access that pipeline of notes that might be available?
Couple things. Getting out and going to investor events that are there. And one of the primary benefits is that who attends those events? Note investors do. And so when you go there, that's where you're going to be in a room full of hundreds of people that are active in this business. Now, some other ways, as I mentioned earlier about investing in a note fund, that's a great way, especially for someone starting out that's new in this space. It's a great way to get involved in the business, in the industry where it's supervised. It's supervised by others with a lot of experience. And so that's very helpful. And it allows new investors to get acquainted with the asset class and to start learning about some of the nuances as well. At the same time, they're participating, earning cash flow, benefiting from ownership of a asset like notes. And so that I find that really helpful, and I often will teach about that, recommend about that idea to people that have asked me that question about how to get started, because it's not like you can, like a property, you can get on the MLS and look up properties and buy them. It doesn't work that way. It's a little bit more of a non-public marketplace. And so it does require having those relationships. But yeah, that's some ideas for how to get started. And I talk a lot about this in my book that I wrote about note investing. Dedicated a whole chapter to how to go about finding notes to buy, where to go, where to buy them, how to analyze them, and really get a handle on what it is you're looking at.
What is a profit potential of investing in notes? Can you give us an example from your own portfolio of a note that you bought, sold, and the kind of profit you made on it?
There is no limit. It comes down to how good are you at negotiating, because the price of a note is agreed to by the seller and the buyer, and notes are customarily sold at a discount to what's owed. And so you can go anywhere from losing money on a note or earning zero on it to earning a very high rate of return, especially if you are in a situation where someone needed to raise capital fast. And so they sold a note at a steep discount and you happen to be in the right place at the right time, you could benefit from that. It's just like buying a property at discount. You make money when you buy, right? And so if you can negotiate well and close on a transaction, you can do really well. Another aspect that comes into play is how much risk are you willing to take? Are you comfortable with as an investor? Notes with low risk, where the collateral is beautiful property with a high value in a prime, pristine location and a perfect track record. A note like that might earn you 4, 5, 6% rate of return. Now, if you're willing to take on a note that's a little riskier, maybe it has spotty payment history, or the collateral is not as clean and pristine, or it's not in a great location, now you're getting into some more higher risk scenarios, and the rates of return on those could certainly jump up into the double digits.
Talk us through some of the variables like unpaid balance, actual cash value. What are the metrics you look at when you're considering acquiring a note?
The metrics we look at when acquiring a note it's pretty basic. You're buying a cash flow stream. Think of it that way. And so what are the variables? You have your rate of return. You have the number of payments, which is the term, the payment amount, and the present value. The present value of the note, which if you're buying at a discount is going to be less than the loan balance. So for instance, let's say we had a note with a $100,000 loan balance, okay, 30-year term, and 6% rate of return. You have those variables, and then you solve for the last one, which is the payment amount. You put those into a financial calculator, and we'll give you the payment amount, which is $599 a month. And so if you have that, now you want to buy that note at a discount. So instead of $100,000, now you reduce the present value to $90,000. Okay, let's say you get a $10,000 discount, and then solve for the new rate of return. It's going to go up. It's no longer 6%. It could go up to 7, 8, 9%, depending on how that present value fluctuates. And so those are some of the factors that for us as note investors, one of the big skills is get good at using a financial calculator. And it's all about the top row of buttons, those 5 buttons on the top row, which dictate all the parameters. You have 4 and you're solving for the last variable. And so that's really the heart of it, is getting good with the financial calculator. And then from there, you can solve for anything you need.
I have my financial calculator right here, which does that. I'm going to show up for those watching YouTube. It's the HP10B2 or II Plus financial calculator. And yeah, I'm holding it up right here.
Yeah, I have that as an app on my smartphone, and I love it. It's great. Yeah, it's powerful, and getting good at using that, which just takes some practice. It's not hard. There's a lot of free online resources and courses you can take to learn it, to get good at using that top row of buttons, and then you'll be really set up for success as a note investor.
Can you give us an example of a big win that you had in investing in notes?
Absolutely. Had a colleague that had reached out to me that they were faced with a big opportunity, investment opportunity, and they didn't have enough capital for it. And so they needed to raise a lot of money, cash, quickly. And so he contacted me, reached out and said, "Hey, Fred, I know you're liquid. Are you interested in buying some notes? I'm going to sell some of my favorite notes. I'm going to sell them at a discount with the idea that I need to close quickly, like in a week. I need this funded with money wired over, and I'm willing to take a discount." And the reason they were selling the notes, nothing wrong with them, nothing at all. But the fact was that he needed liquidity quickly because he had a great deal he was going to get into. And so that was a huge win for me. We stepped in, we bought the notes, and everything went well. The seller was happy because they got their money very quickly. We were able to deliver that. And then we were happy because we bought some great assets that have a strong cash flow.
What kind of discount did you get on those assets?
The return was in double digits. Let's put it that way.
What do you typically look for in your returns? Are you getting double-digit returns on a regular basis, or are you getting single digits?
Both. But we like to buy notes that are not in the best condition, that have a little more risk. And so those can warrant higher rates of return. A lot of times, there are problems that can be solved. And so it's really interesting. There could be notes where there's some kind of a title defect or a material issue with the loan file. And those kind of things, a lot of people will shy away from. But knowing your way around that, how to solve those problems, you're okay with buying it because it takes a little time, it takes a little money and expense, and maybe some legal work has to happen, but you can clean up a note file. And so it's really a lot like the idea of someone that buys a property that needs repairs and needs work. They buy the property, they fix it up, they improve the property, and then increase the value of it. And so we've had a lot of success doing that with notes as well. We look for notes that have a good track record, good payment history, and good value, as well as potential for opportunity and increasing the value.
What's your favorite hack or app?
My favorite app. It's what we just talked about. I'll show you this. It's the 10BII app on my smartphone. And I'll tell you what, Brian, it's the best $6 I've ever spent.
It can be very powerful when you're looking at notes.
Yeah, I have it. It's always with me. I don't have to find it. And so that's a great app. And so I'll share another one that I love is using a good CRM, client relationship management, a good CRM tool to keep track of the people you build relationships with. Could be other investors, note sellers, note buyers, and keeping that information organized for you, because as note investors, we're all in a sales role. We have to maintain and nurture relationships. And so for people that work in sales, they all use a CRM to organize their contacts and stay in touch with people. And so that is another powerful tool that gets used every single day for us.
What do you use for your CRM?
I use Pipedrive, but there's many excellent products out there. And I always say the best one is the one that you're going to use on a daily basis. So find the one that you like and then use it. They all do the same, they have the same features and functionalities. It's pretty basic. So just get one that you're going to use consistently. That's my advice with that.
How would someone get a hold of you or find out more about you?
Couple things. I have my book. It's available on Amazon, and it's called The Little Green Book of Note Investing. It gives a great high-level overview and touches on a lot of what we spoke about in our conversation today. For anyone that's interested to connect with me, you can visit my website, which is fredmoskowitz.com. Or if you prefer an easier spelling, you can go to giftfromfred.com. and we'll take you right there. And if you prefer, you can text me by texting the keyword money to this number, 215-461-4433, and then just follow the prompts. I always love connecting with investors and networking, and so I really look forward to hearing from you and connecting with you in the near future.
Fred, thanks for coming on the show today to talk about mortgage notes. You've done a great job explaining what they are and how they work and different ways to go about looking at them and analyzing them. It's been a real pleasure having this conversation. Thank you so much for being here today.
Thank you, Brian. Appreciate it.
I want to thank everybody for listening to this episode. I'm your host, Brian Hamrick from Hamrick Investment Group, and you can find out more about me by going to higinvestor.com. That's HIG investor.com.